Hello, my name is Sezen Uluda. I am going to introduce the 7th chapter of Introduction to Business book, which is named as Accounting and Financial Analysis. But first of all, let's look at the learning outcomes of this chapter. After completing this chapter, you will be able to define accounting and relevant terms, identify the users of accounting information, describe and distinguish the areas of accounting, describe the profession of accounting, understand the recording process, identify the content and purpose of the basic financial statements, explain and understand the financial statement analysis. Throughout this chapter, you will study how financial accounting functions within the business entities. However, before beginning on the study of accounting, you need to know and understand some basic terms of accounting. We can define accounting like this. Accounting is an information system that measures business transactions or economic events, processes the data into reports, and communicates the results to decision makers. Accounting consists of three basic activities: identifying, recording, and communicating. Source documents such as a sales invoice will be used to identify the economic event, and then it records those events in the accounting books like journal and ledgers. Finally, the company communicates the collected information to interested users thanks to the financial statements. You will learn the users of accounting information. The users of accounting information can be classified as internal and external users. Internal users are managers who plan, organize, and run a business, like marketing managers, production supervisors, finance directors, and company officers. The second one, external users, they are individuals and organizations outside a company who needs financial information about the company, like investors, creditors, taxing authorities, customers or clients, labor unions, regulatory agencies. And here is the areas of accounting. The first one, financial accounting. It measures and records business transactions and provides financial statements that are based on generally accepted accounting principles. The second one, managerial accounting. It is considered with providing information to internal decision makers. It uses both financial accounting and estimated data to aid management in running day-to-day operations and in planning future operations. After studying accounting terms and definition, users of accounting information, and areas of accounting, you will find information about accountants and accounting profession. Let's look at some definitions, some explanations. A private accountant works for a business in any position not included in public accounting. Public accountants and their staff provide services to the general public on a fee basis. Public accountants who meet education experience and examination requirements may become a certified public accountant. While studying recording business transaction, you can see this figure in your book. The accounting cycle is a set of steps that are repeated in the same order in every period. This process, starting with obtaining data from business transactions. The transaction is recorded in the journal. The third step is to post each journal entry to the ledger accounts. The accounting cycle requires summarizing of the entries in a trial balance, which is a list of all accounts. After preparing a trial balance, the next step is recording the adjustments. The purpose of adjusting entries is to match incomes with expenses during the accounting period. Then we can prepare the financial statements. Final step of the accounting process is closing the revenue and expense account. And here is our equation, accounting equation, assets equal to the liabilities plus owner's equity. We can define assets like this. Assets are economic resources a business owns. Liabilities are existing debts and obligations of the company. The owner's claims to the assets of the business are called equity, also known as owner's equity or stockholder's equity. Then you will find the term account. An account is a detailed record of increases and decreases in a specific asset, liability, or owner's equity item. Instead of using the term left side, we are using debit side for each account, and instead of using the right side, we are using the term credit side. Accounting uses a double entry system, which means that we record the dual effects of each transaction. Every transaction affects at least two accounts. And here is the rules for each type of account. We must enter increases in assets on debit side and decreases on the credit side. We must enter increases in liabilities and owner's equity on credit side and decreases on the debit side. Here is the financial statements. The most important financial statements are balance sheet, income statement, and cash flow statements. Let's start with the first one. Balance sheet, also known as statement of financial position. A financial statement that reports a business assets, liabilities, and equity on a specific date. A balance sheet has two sides, as you can see. Assets are listed on the left, liabilities and equity are listed on the right. The total amount of the assets must equal to the total amount of liabilities plus equity. The second one, income statement, also known as statement of profit and loss or statement of operations. We can define like this: financial statement that shows the amount of sales, all the costs incurred in making those sales, and all the overhead costs incurred in running the operations of the company, so it will be able to deliver on its promises to customers. We can see all the revenues and expenses for a period of time. If our total revenues are higher than our total expenses, it means we have a net income. And from income statement, gross profit, operation income, income before taxes, and net income can be seen. There may be a net loss, it's a possibility. In this case, we can see all of the related details about this situation. The last financial statement, statement of cash flows, which reports the cash coming in and the cash going out during a period. This financial statement reports cash flows by three types of activities: operating, investing, and financing activities. And this is the last subject of this chapter, analyzing financial statements. Financial ratios provide a quick and relatively simple means of assessing the financial health of a business. Ratio analysis expresses the relationship between the selected items of a financial statement data. Financial ratios are commonly classified according to the characteristic they measure: liquidity ratios, efficiency ratios, debt ratios, and profitability ratios. And the first one, to measure and evaluate of liquidity, we can use net working capital, current ratio, and quick ratio. To measure efficiency, we can use accounts receivable turnover and average collection period, asset turnover, inventory turnover, and days of inventory outstanding. To measure and evaluate of long-term solvency, debt to total assets ratio, debt to equity ratio times interest earned can be used. And lastly, to measure and evaluate of profitability, we can use gross profit margin, operating profit margin, net profit margin, return on assets, return on equity. I hope that this presentation can be useful for you. You can find more information, exercises, and details in your book. I wish you all success.